Okay, hello everyone, it's Jefford again from Rubik's Academy. Alright, today we want to look at a company that probably any child will know. Any child, teenager will know. Alright, this is not just about stocks, it's not just about equities. It is a company that is already a household name. And that company is Walt Disney. Alright, so I said in the last video, I will improve the flow of the content. Pardon me, I'm still learning. Okay, and today I'm decided that I will be looking at one company at one time, but I'll be typing down all the important content. Okay, all the important facts so that we can do a side-to-side comparison after that. Okay, so we're just gonna look at Walt Disney and its closest competitor. All right, so without further ado, let's do it. Okay, so Walt Disney, let's go. First thing I want to see is the fact that you can see that the EPS of Walt Disney is $6.11979 USD per share. EPS stands for earnings per share. Earnings is net earnings. That means after deducting all operational expenses, okay, all outward costs, whatever that's left, the net earnings divided by the total number of outstanding shares. Okay, total number of outstanding shares includes restricted shares, but may not be equal to total number of authorized shares. All right. So earnings per share is 611, not too bad. Piotrowski F score is pretty bad. Okay, Piotrowski F score is only 3. Okay, Piotrowski F score measures 3 things. All right, profitability, leverage, and operational efficiency. So in other words, it's trying to measure how much money a company is making, how fast it is making that money, how effectively it is making that money, and how much debt has it accrued before you make that money. And you put both debt, liabilities, and income together, what is the overall financial status and financial positioning of the company? The maximum score for Piotrowski F score is 9. The minimum is 0. The best score is 9. The worst score is 3. So is 0, sorry. So for Walt Disney, the Piotrowski F score is only 3. That means in terms of profitability, leverage, and operational efficiency, it is really not that great. Okay? Next. Later, we'll be looking at its closest competitor, which is media conglomerates. All right? So for now, we'll focus on Walt Disney. Okay, that's all for this page. Let's go on to financials. Okay. Okay, let's go into financials. What do we have here? We're looking at gross profit. Gross profit is about, whoa, it's pretty good. It's about 23 billion. All right, 23 billion in terms of gross profit. 23 billion times 1,000, 23,000 million. Yeah, 23 billion. $23.057. Now, if you are wondering why is it billion instead of million, because you see only 8 figures here, it's because all figures need to be multiplied by 1,000. All right, as you can see here, there's an apostrophe times 000. So it's trying to say that all steps below, you have to multiply it by 1,000. And also at the same time, it doesn't make sense that Walt Disney is only making 23 million per year, per quarter. It doesn't make sense. Okay, so if you compare the 2 quarters from March all the way to September 2019, you can see that there was no quarterly release on December 2019. I'm not sure why. Okay, by right, they are supposed to release quarterly earnings, but somehow they did not release during December. I am not sure why. Okay, but we gotta work with what we have. Okay, so you can see that from September 2019 to March 2020, the gross profit is almost the same. Okay, and this is largely due to the fact that although the movies have stopped during the pandemic, okay, But there is all the home entertainment products like Netflix, shows, cartoons, Cartoon Network, all these things that are still going on. That's why probably you don't see a huge decrease in terms of profits for Walt Disney. Okay? Now that's going to be different for the airlines, but that's a story for another time, right? Okay. Then we're going to look at net earnings. Net earnings is about 5 billion, right? Net earnings is about 5 billion. $5.381 billion. Okay, is it fantastic? I would say it's okay. All right, later you'll know whether it's fantastic when we compare it to its closest rival. All right, so next thing I look at is net asset value, my favorite. All right, net asset value is $50. All right. Net asset value, NAV. In case you're wondering what NAV is a measurement of the intrinsic value of a company. The intrinsic value are things like its data valuation, its clientele, its current inventory, its standing inventory, its physical assets. All that forms the intrinsic value of the company. Then the extrinsic value are things like the sales figures, the marketing campaigns, market share, your things like your share price, your market cap, right? All these things form the extrinsic value. For those of you who know me, I always put emphasis more on intrinsic value than extrinsic value. I always emphasize more on intrinsic value than extrinsic value because I always believe that extrinsic value can be easily manipulated. It can be easily affected by external events. But intrinsic value is always the best benchmark of how strong the company is in terms of financial positioning. All right, the intrinsic side will affect the extrinsic side more than the extrinsic side affecting the intrinsic side. That is my view. All right, you can have your own view, but my view is intrinsic value is king. Okay, $50 and all right, what other matrix are we interested in? Let's take a look. Maybe we can look at, because the Piotrowski F score is so low, but the net earnings, and you see such a huge discrepancy between gross profits and net earnings. I have a feeling that this company has accrued a lot of debt. So let's go to the debt to asset ratio. Okay, debt to net profit. Debt to net profit is $11. Wow, that's pretty high. Okay, maybe this is normal. Maybe this is normal for a company like Walt Disney, right? But it's $11. So in other words, what does that mean? It means that for every $1 of debt, they have $11 of net profit. 1:11. Okay, debt. As you can see over there, it shows long-term debt and short-term debt divided by net earnings. So for every $1 of debt, okay, you have $11 of net earnings. 1:11. It's not too bad. Debt to cash flow is about, let me type that down. Debt to cash flow is about $10.67. So you can see that in terms of net profit and cash flow, the figures are very, very similar. Okay, it's very, very similar. And that means that a huge part of the net earnings might, okay, so when it's so similar, what can you observe from a very similar debt to cash flow and debt to net profit ratio? It means that the company, all right, has both enough cash flow to counter its debt, to offset its debt, and also enough net profits for the shareholders and the investors. It's a good sign, right? Debt to assets is about 0.2. So you can see that debt to asset, here asset doesn't just refer to tangible asset, it refers to all assets. Okay, total assets. So your data valuation, all that is all inside. So for every $1 of debt, you have 0.289 worth of assets. For a company like Walt Disney, I believe this is normal because Walt Disney is not a capital equipment intensive company. So this could be normal, right? So that means most of its asset value may come from data, its clientele and all that, okay? The other thing I want to look at is return on equity. I'm very interested in return on equity. That is ROE, right? Okay, return on equity is 5.952%. Return on equity, what is that? That means for every $1 that the investor has put into the company, for every $1 worth of equity, how many percent are they getting back on a quarterly basis? Okay, because this is all quarterly data. So you take that data divided by 3, you will get monthly basis. Okay, so right now the ROE is about 5.952%. 5.952%. Okay. It has dropped a lot since September 2019, which means if you have pumped in equity investor, all right, I want to just remind all of you, this does not take into account break even and all that. That break even is a whole different concept. The investors of Walt Disney would have broken even a long time ago. All right, but they are just measuring from the total amount of equity that has been pumped into this company based on current earnings, how much percentage they are getting back per month. So this has nothing to do with breaking even or not. Okay, I just want to remind all the people who are watching this video. This has nothing to do with whether the investors, the equity investors have broken even on their investment or not. Nothing to do. Okay, this is just taking the total amount of money that has been pumped and injected into the company and express it as a ratio of the amount of money they are getting back per month. Okay, and of course, these returns on equity is definitely coming from the net earnings. You cannot take gross earnings and give it to the shareholders. Doesn't make sense, right? That's not how accounting works. You always take net earnings. All right, as you can see, they already give you the formula: net earnings divided by shareholders' equity minus other share capital. All right, so in other words, whatever you get back as an equity investor comes from net earnings, 5.952%. It's dropped a lot. It's dropped almost by half. And of course, before that, in 2018 and 2019, it dropped by another half. So this is not a good sign. This is not a good sign, okay? Not a good sign at all. It's not a healthy company if your equity percentage return is getting lower and lower. Of course, this could refer to the fact that another reason for this statistics is that in recent years, 2001 and 2020, there has been a huge injection of capital into the company, maybe to expand, maybe to acquire new companies, maybe to come out with new products. I don't know. All right, because this statistic, return on equity, takes into account fresh funds that have been injected into the company. It's the total amount of equity injected to date. Okay, so that could be another reason why. But overall, this is not a good sign. It's not a good sign. Okay. All right, we're done with Walt Disney. We are done with Walt Disney. So we're gonna compare Walt Disney to another company. We're gonna compare it to Okay, so we're gonna compare it to media conglomerates. Why is it doing this to me again? This is the problem with all the statistical websites, right? The bandwidth, they don't have enough bandwidth for all the user access, especially during this time where everybody is just at home. Okay, finally. I think we are finally going to go. Why is it like that? Okay, let's try Esports Entertainment Group. Okay, I think, all right. Looks like that is not going, so we are gonna look at Esports instead. All right, Esports Entertainment Group. So Esports Entertainment Group. All right, first thing I see is his Piotrowski F score, but let's not look at that yet. Let's look at our earnings per share. It's negative. EPS is negative 0.65, which means, what does this mean? It means that you are basically losing money per share. The company is in a red. They do not have enough net earnings to be allocated to on a per share basis. That's why it's negative. That's not good. That is bad. All right. So Piotrowski F score is 1. Ridiculous. That is ridiculously low. All right. We're gonna go on to gross profits. I mean, we can see the clear winner already, right? I mean, it's pretty obvious, but it's okay. Let's just go through the process. Okay, so there is no gross profit. The company is in a loss. Okay, if it's bracket means that it's in a loss, guys. Okay, there is no profit to speak of. So if there's no gross profit, there shouldn't be any net earnings. Yeah, it's a negative. All right, it's pretty bad. It's pretty bad. Okay. Gross profit is 18, so it's 18 times 1,000 is negative 18,000. Net earnings is even negative as well. All right, I'm not gonna put the figure down. I'm just gonna put it as loss because that is itself is bad enough. All right, and he has been losing for a few quarters already. All right, you can see bracket, and the bracket, the figure inside the bracket is getting bigger. So that's just bad. All right. Okay, next we're gonna look at NAV. NAV is negative as well. Wow. Negative 2.22 USD. Okay. Usually if gross profit and net earnings is negative, anything from that onwards is gonna be negative. That is usually the case because net earnings is the base metric for a lot of other metrics. All right, net earnings and total assets. These two are the base metrics for a lot of other metrics. Okay, next we're going to look at debt to net profit. Non-manageable, not measurable. Okay, so what does that mean? Whenever you see not measurable, it means that it's not. They cannot report it because it's not even a positive number. All right. Debt to cash flow is also not measurable. Debt to assets is okay, it's 25. So they got a lot of assets right there, right? Debt to assets. Okay, so they have a positive debt to asset. All right. Probably they have a hugely positive debt to asset. Probably they have a lot of inventory, a lot of new technology that they have actually sort of bought all these equipment, and that's why, or maybe they have a huge data list and the data is worth a lot, so that's why the debt to asset is very, very high. Okay, and then we're gonna look at ROE next. Where is ROE? Right there. It's not measurable. All right, so again, it's not measurable. That's not good news. It means that they are not publishing the figures. Okay, so now we're gonna switch to the other screen. Okay, so for those of you who can see, all right, you can see that these are the figures, all right, and if you put them side to side, you can see that Esports Entertainment Group is disastrous. All right, Walt Disney is still considered a healthy company, especially with such a high NAV. All right, debt to asset is obviously not as good as Esports because of the fact that probably they have a lot more debt. They could have a lot more debt. All right, that's number one. Number two is they could have a lot less asset. Okay, or the asset type is just not as measurable as Esports. I don't know. But looking at the other matrix, Walt Disney is definitely a better company to invest in as compared to Esports Entertainment Group. All right, at least it has a lot more intrinsic value. Okay, so that's all from me today. Thank you very much. My name is Jefford Lim. Once again, I am coming to you from Rubik's Academy. Please subscribe for more such reports. Thank you so much. Thank you.